Good morning, folks. Good morning, folks. Happy Taco Tuesday to you. Hope everyone out there had a good weekend and a good extended break. We could all use them here and there. We'll be getting started in just about 4 minutes here. Welcome, everyone, to this episode of Back to the Futures with me, your host, Markets and Mayhem. And we're going to get started here in just a minute, go through a couple of slides, and then get right into what's going on with the markets around the world, focusing here on U.S. markets, equity futures, stocks, and some of the commodity futures and rate futures as well. So I think it'll be a jam-packed session. So let's get right into it. First, everyone's favorite slide, the general disclosure. All Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered investment advice nor recommendations. And really the key here is just do what works for you, learn from others, including myself and other traders and investors, but figure out a system that works for you and your goals and the way that you want to manage risk. That's really the most important part about this. All right. So moving right on, the folks at Bookmap would love for you to join their Discord. They've got a lot of cool stuff going on. And, it's really just a great community to check out, to learn about the product, to learn about some of the folks on the team and what they're up to. So check out discord.com/invite/bookmap. You can also use the QR code on screen. And a little bit about me. My trading journey began in 2005, so I'm dating myself a little bit here. But I've been at this game for 20 years. It's been 2 amazing decades. I wouldn't switch it up for anything else. It went at very first in the very early stages of this was more of a hobby to take some of the profits that I had, some of the spare cash I had sitting around, and turn it into a different way of earning money. And then as I was trading and I was earning money trading, I decided to roll some of that into investments as well. And that led me to starting to really invest in 2006 and becoming more active, learning about the stock market. And of course, I couldn't avoid the great financial crisis. It played out from late 07 through early 09. I was lucky enough to get out of the way of much of it, mostly by being a discretionary, technical-driven trader. And that helped me in the sense that I just saw a big chart of the S&P. It couldn't get above this key level of resistance. And I said, you know what? I'll just step out of the way for now. If I'm right, then that means the market, retraces a bit. And if I'm wrong, I have to buy it back at a higher price after it's proven that it has more room to climb. Well, it ended up that the great financial crisis played out, and there were some clues along the way. We had a money market lockup in August of 2007. We had lots of volatility in China and Japan. We had mortgages being issued to anyone that had a pulse, but I don't think a lot of people knew just quite how deep it would go. I certainly didn't at the time, and that had me really wanting to learn more about the plumbing underneath the surface of markets, the monetary policy components, fiscal policy, earnings, the flows, the options market. So I spent a lot of time refining my approach, going from a technically driven discretionary trader, which I know a lot of folks out there are right now, to becoming much more systematic, taking emotion out, taking a lot of the psychological weaknesses we have out as human beings and focusing much more on momentum, price actions, flows, sentiment positioning, volume profile, and the big picture. And it sounds like a lot to keep track of, but the reality is that once you start to build a more systematic approach, you have models, you have regular data sets you're looking at, you start to form your approach based off that data much more elegantly. And you can automate some of that data harvesting and the analytics behind it. So you have the opportunity to really have that data without having to comb through everything manually. And that can jumpstart how much time. Like, for example, on the Trader Aid Discord, I'm constantly adding new ways for our members to save time. Actionable pivot levels, options levels, other things that we might have had to kind of chart out and gather that data for. Now that's being automated, and then I'm trying to provide updates regularly about what that may mean for market flows and direction as well. So I began working with Bookmap in early 2022 because I saw great value in the way their platform displays market data. And that's really what today is going to be about, focusing more on what all Bookmap can do for traders out there that are learning more about trying to gauge the different elements that are moving the market. For me, Bookmap adds to that systematic process because it provides me an easy to use visualization of a lot of important data, including where there's interest and where there's flows coming into the market. And then with my SPX options visualizer, also showing the options impact on the S&P 500. Now, I co-founded TraderAid in 2022. Really, the goal there was trying to build something that would have benefited me early on. Even though I had a lot of great mentors, I never really had a community. And I certainly didn't have the kind of trading tools and actionable ideas and insightful educational content that we provide our members. And the goal is to jumpstart people, but also to improve their odds of success. We know about 90% of traders fail. It's a sad statistic, but it's a very real one. So we really built this around the idea of trying to improve the odds for our members. I founded Macrovisor in 2023, co-founded, to share my experience, ideas on market opportunities and education, some of the longer time horizon ideas that are playing out. And I also build a number of unique tools and models and provide one-on-one coaching for both traders and investors. Now let's talk a little bit about why I watch order flow. I think this is an important primer for when we're talking about why I use Bookmap, right? Because Bookmap is a tool that gives you a very unique way of watching order flow and an easy way to layer other elements of data on top of that, which can be quite helpful. So the basics are watching for differentials, or what we call deltas. That's a key that you're going to hear me talking about, that you hear other order flow analysts looking at. And it's deltas in the volume and how it's being expressed. It's also deltas in the session volume profile. So not just the tick by tick deltas, but the session volume profile deltas also matter quite a bit. And then you can zoom out and you can look at longer term volume profile deltas, which also matter. A lot of the order flow analysis and finding where the aggressors are and where there may be opportunities comes down to that delta analysis. Another area I like to watch is icebergs. Icebergs are really important because you have a view with Bookmap and with the way Rhythmic packages up the data that they're able to access from CME to find what are qualified iceberg orders, not just guesswork, not just looking at a volume profile and thinking this may be an iceberg because there's this wedge here, more of actual icebergs coming in as they're happening. And then we can start to get a sense as to what that may mean for the market, especially if they're larger icebergs. 2,000-3,000 lots happening in a transaction can be enough for the S&P futures to look at, and sometimes even reverse from that. And we can see in the price action how momentum may shift in the aftermath of those types of icebergs as well. And then exhausting trading action where one party gets off sides. And sometimes you'll see that in the deltas. You may also see that emphasized by the icebergs. I've built an exhaustion indicator on top of Bookmap as well to give me some ideas to where these events may be happening. And the point is, when one side gets a little bit too aggressive, a little bit exhausted in that flow, that can provide us an opportunity to A, de-risk if we're on the right side of that trade, and B, potentially ride that reversal of momentum. Because, if you see one side getting way too aggressive, often is the case, you're going to see either consolidation or even momentum shift against them. Now, why do I use Bookmap? Well, obviously, talking a little bit about the order flow gives you all a bit of a sense as to why, but let's talk about it in a little bit more granular detail. First, the visualizations. I do enjoy the heat map. I like the way that Bookmap is able to display data in a way that I haven't found other software being able to do. And then the ability to layer on other elements of data, the stops, the icebergs, exhaustion, absorption, the options flow that I've built a tool to add into. All of that helps me make better informed decisions on the fly rather than having to look at several different screens or several different sources of data. I generally am looking at two different charts, right? I'm looking at Bookmap for the intraday, and then I'm looking at Motive Wave to zoom out just a little bit more and see some of those larger actionable levels. So I like that powerful visualization, the key data, all of that really being on one screen for that intraday analysis, and then the ability to easily layer on new features. Now let's shift topics just a little bit here, looking at the S&P 500 options chain going into today's trading day to identify some key levels. And if you want, you can screenshot this, save it for later. Going into today, the big level is 6,000 on the S&P. We're set to open above that. And sometimes you sort of see markets like to hop over these gamma levels pre-market. So S&P right now, futures imply a cash open up about 0.5%. So that's a pretty decent setup for today. We're going to basically jump over that 6,000 area pretty effortlessly. And that sets us up for what I think will be a pretty decent trading day. I think that gives us the opportunity to see some positive continuation. We also have Trump coming in office and saying that terror aggressive as maybe some people suspected, which is also ostensibly good news. Now, we do have heightened, I would say, headline risk. We remember from 2017 to 2021, Trump loved tweeting. And when he tweets, it moves the market, sometimes individual stocks, sometimes the whole tape. So just be aware those communications, whether they're coming out from press conferences, from tweets, from other areas that permeate the headlines, we do have to deal with that heightened volatility. We also are dealing with a market where there is some lower liquidity. We're post options expiration, which means we're unclenched from some of that gamma exposure. And the further we move above or below 6,000, the more we're also free to move about. So I do think we have some interesting catalysts, some moving pieces. Quarter one earnings season's also off to a decent start. I wrote a note for our Trader Aid members on the Discord today highlighting what we're seeing there, but overall, pretty constructive. So going into this week, the first trading day of this week looks like it's a solid setup for a green day. Obviously, we'll look at the 20-minute opening range. We'll look at the order flow and especially what's going on in SPX options to get a better sense as to where the day may take us here. Now, my daily pivot that I'm really watching is 60.59. I think that's a level to watch pretty closely. I've noticed that for whatever reason, the presentation is not showing that on screen here. So I do apologize. Here we go. It's decided now to show the slide. Awesome. It's good when technology works. So the daily pivot level, ES 60.59, that's what I'm going to be watching closely as to how we interact with that after the cash open. Going into the cash open, we're trading above it. And I think that we're likely to sort of test it from above, maybe dip below. But as long as we're able to hold and build above 60.59 on an intraday basis, I'm much more inclined to want to take longs in S&P, in NASDAQ, and in some of the leadership stocks, which we'll be highlighting in the order flow analysis as we get to that part of the demonstration. And before we get into that, that's coming up right next. We'll be looking at Bookmap. We'll be looking at some of the leading futures contracts and most popular stocks. But I wanted to share two exclusive deals with you all. One, you can get up to 40% off of Bookmap. Visit traderaid.com/bookmap, scroll down to the special offers. So again, you can get up to 40% off Bookmap. Visit traderaid.com/bookmap, scroll down to the special offers. You can also get up to 20% off of Trader Aid by using the code Mayhem20 at checkout. Just visit traderaid.com, click on our Discord page and sign up, or go to whop.com, WHOP.com/TraderAid. Sign up there. Either way, use the code Mayhem20 at checkout for 20% off, and you'll also get a 5-day free trial if you select our monthly plan. So with that all being said, we're going to go ahead and close out of the presentation here and go right into Bookmap on screen. We've got the S&P 500 futures, and let's just zoom out a little bit here. We can see overnight, pretty much constructive session here. We had a rise off the European Open, a little bit of a retrace, a little bit of consolidation as we approach the US Open, but then we started to see that push again. We're not quite to the pre-market highs here, but we do see interest building above us just around those levels as well. So that is constructive to see that ahead of the open. You can see there's interest in higher prices in the heat map as well. Let's take a look at the NASDAQ. We're also going to zoom out to the overnight session, and you see a very similar look. You have this accumulation. There was some attempt by sellers to absorb that accumulation here. You can see those red boxes. Those are my accumulation indicators, or those are my absorption indicators, I should say. And those were sellers basically trying to lean into that buying, and to no avail. So that's a good sign. That's a sign that that attempt to absorb those buyers didn't really have pronounced impact. So we saw, again, some consolidation. And what's interesting here is on the other side of the tape, that absorption by buyers of sellers did have an impact. So sellers were trying to absorb that buying flow, no measurable effect, really. But when buyers stepped in to absorb the selling pressure, it put in the lows. So you can see already there's some favoring of buyers ahead of the US cash open just by the way that these futures contracts are behaving. So NASDAQ, like the S&P 500, setting up for a pretty constructive open and actually looking a bit better overall, revisiting and even making new pre-market highs ahead of the open. Now let's look at some of the other futures contracts here. The 10-year note futures are a pretty key contract to watch. We know that because as interest rates were rising above 4.5% with some momentum, that was causing increasing jitters in equity markets. So seeing some reprieve in rate markets going into today is actually a pretty constructive backdrop as well. We do want to see rates get below 4.5% to become much more constructive. Right now, they're just at 4.56% on the 10-year Treasury note. That's not bad. We've come back quite a ways. Remember, not long ago, we were trading at about 4.8%. That was a yield where there were headwinds increasing. You've got $100 trillion of global debt that keys off that 10-year rate. A lot of that debt is dollar denominated. So when the dollar was rising and 10-year yields were rising, that was starting to put pressure on global liquidity. Now that we see the dollar coming down, now that we see 10-year yields down about 24 bips from their highs, that's very constructive. That's exactly what we want to see, and we'd love to see some more continuation of that. Perhaps we'll have a chance with a 20-year bond auction this week to see better demand coming into these longer duration markets. But overnight, we can see 10-year note futures fell a bit, and as that's happening, that's pushing yields up. I know that sometimes tricks up folks that are a little newer to this, but when the price of a bond goes down, or a note or a bill, the yield goes up, and vice versa. The same thing is true of a dividend stock. Dividend stock goes down in price. The dividend ostensibly stays the same, but the yield, what you're paying per share and what you're getting back in yield, goes up, right? So it's similar. So now we can see that from about 6 a.m. on, we've bottomed and we're now pushing back up in price on the 10-year note futures. That is helping to bring down yields by about 5 bips here ahead of the open. And let's check on Euro futures. This is basically the anti-dollar. If we're talking about the US dollar index, the majority of it is weighted towards the euro. And so seeing the euro start to make that push pre-market, also a constructive sign because you're seeing that weakening dollar. About 40% of S&P 500 company income comes from overseas. A weaker dollar tends to be constructive. It tends to make both their offerings more appetizing, but it also helps with some of the currency headwinds we would have with a stronger dollar, potentially capping out some of those earnings as they convert, because these companies don't necessarily do a lot of Forex hedging. So seeing that move ahead of the market open, also constructive. Let's take a look at gold here. Overnight, bit of a choppy session in gold, selling off from the European Open, making lows just after 4 a.m. Then another attempt to make a new low. That failed. We made a higher low, and we kind of off from there, making a series of higher highs and higher lows from that original low. So that is a reversal pattern in gold ahead of the market. That is constructive for the precious metal. Now, for a longer term view of gold, I do believe we're likely to see $3,000 an ounce this half. Remember, my outlook was for about 2,700 in September of last year. We saw that. We've been sort of consolidating since. I do believe we're on the road to make that next push higher, and it's going to have a lot to do with the path of the dollar, the path of interest rates, but most importantly, uncertainty. Gold is a global uncertainty hedge, and we have a lot of uncertainty in terms of policy, in terms of geopolitics, in terms of the economy. So I think gold will do well in that environment. Silver, not looking quite as good as gold in terms of its longer term technicals, but this morning it certainly looks solid. It, like gold, had that low made around 4 a.m. and we've been just sort of consolidating. So we had about a 2-hour period of consolidation. Then we broke out of that range and we started to make that push higher in silver as well. But I will say silver's longer term chart still looks a bit questionable. Lower highs, lower lows. Really love to see it break out of that and show positive momentum again. Maybe even it ends up being more of a bull flag pattern if it does. I'd love to see a big break above 32 to kind of confirm that we're starting that move. But for now, silver is keying off of China because China is about 15% of global silver utilization. A lot of silver gets used there for renewable projects, for communications, and otherwise. And without a larger domestic stimulus program, it's likely that silver will languish. So that's going to be the big catalyst. And you'll notice in the past, when China talks about larger stimulus programs, silver gets up and moves. So if there's some substance behind that, and we haven't had much over the last 2.5 years, but if there is this time, if this time is indeed different, I think silver can put in a pretty powerful rally, but it really has a lot to do with China. Copper is another one that we're going to be watching really closely this year. Going from last night, a bit of a similar pattern to the precious metals, but actually making a new low around 6 a.m., unlike gold and silver, and then starting to push off of that. Copper's chart looks a lot more volatile today. It's also a bit of a thinly traded contract, so something to keep in mind going into today's trading session. In terms of the longer term copper chart, one of the things that I'm watching on that is really a break above 4.47. I think if we can see a sustained break above that last high, that'll give us room for continuation. In terms of positioning in copper, it's modest. COT reports suggest that specs are only starting to dip their toes in. So if we do see some momentum, it certainly has room to move higher. And Bitcoin having a great overnight session here, bid up close to 3% to 105,060, with a large amount of interest building overhead here at 106,000 and 108,000. So I'll be watching Bitcoin. A lot of the Bitcoin proximal higher beta stocks are also likely to be well bid in today's trading session. So look for those miners like Mara, look for some of the exchanges like Coinbase, and some of the other sort of proxies that traders like to play like MicroStrategy. All of them, with Bitcoin showing this kind of momentum, are set up to have a constructive day. And crude oil getting beaten down a bit overnight here. The energy product set to open just down about 2.5% here. So we are seeing some pressure in oil. Some of this attributed to Trump's policies to prioritize oil production, but we know looking at that it takes quite a long time to bring that sort of stuff online. So just be aware that with the price of oil here, it's likely to consolidate after such a large move higher, but positioning is still not really stretched. We've just seen some modest increase in long positioning on that contract. Technicals are starting to look more constructive. I'm not so sure that crude's run is quite over yet, but for now, going into today, it certainly looks a little more precarious just on an intraday basis. And then we have natural gas. Natural gas has been a really interesting trading vehicle. It has traced back down from its recent highs. Some of those highs powered by robust demand during this incredible cold snap that is swept across the United States. So in the overnight session, we can see natural gas creeping lower, down about 3.75% ahead of today's session. But overall, the technicals remain constructive. Momentum continues to favor the buyers over the intermediate term. And adding to that, positioning by large traders is still negative in natural gas futures, suggesting that we could still have a move yet. The one big headwind here is that seasonality does not tend to favor natural gas here. It actually is more favorable in the third quarter and into the fourth quarter than it is in the beginning of the year. Now let's revisit the S&P futures. We did hear some of those sounds indicating there was some buyer aggression happening, and indeed we can see a little bit of that playing out. And remember, for today, we're going to be watching that 60.59 pivot. We're just about 2.5 minutes away from the U.S. market open here. And folks, if you have questions as we're going through this live stream, please feel free to pop them in the chat room. Let me know. Always happy to help. And in terms of today's event calendar, really not much going on. Going to be a pretty slow day overall. We do have Netflix's earnings call after hours, however, and I will stream that live. So be sure to tune in. I think that'll be a lot of fun to watch. Gives us a sense as to how some of these live streaming events are going, what they're building up to as we go throughout 2025. We see them sort of deprioritizing video gaming and prioritizing live entertainment, particularly sports. So, question coming in, can you please explain the pressure on global liquidity you mentioned? And so, yeah, there's a variety of different pressure valves, you could say, that are having an impact on global liquidity. We're seeing bank reserves coming down a bit. We're seeing funding spreads come down, which suggests that institutions are lightening up on their positioning. We've seen aggregates suggest the same. We've seen global money supply flattening out. We've seen yields on the rise and the dollar pushing higher, which puts pressure on debt counterparties. You've got about 100 trillion in debt that is keying off 10-year note futures that is also largely dollar denominated. So when both of those move higher, the funding cost of that debt absorbs more excess liquidity. And so a lot of different factors are just showing us liquidity is tightening up. And then if we look underneath the surface and we look into, say, for example, what's going on with the book depth in various futures contracts like the S&P 500, that has also tightened up, right? So we've seen some degree across multiple metrics of liquidity tightening up. And I think that that has an impact. You've also seen it in financial conditions, which have also been starting to tighten as rates are rising. And as we see bank lending conditions tightening, we've seen some degree of defaults picking up and bankruptcies picking up as well. It's just sort of a number of different aggregates suggests there's some degree of increasing financial stress and diminishing liquidity, which typically go hand in hand. And in an environment of lower liquidity, you do tend to see some cross-asset volatility catalysts, essentially. More likelihood that you're going to have some episodic events that can kind of push up those aggregates. And then adding to that, we have a new administration. We have fiscal policy kind of resetting, some of that fiscal excess wearing off. The idea was to hand off the baton to the Fed for a deep cutting cycle to help bring back that liquidity. But the Fed, having seen how much of an impact that fiscal dominance has had, kind of offsetting their tightening, pulling back a bit, more concerned about the potential for inflation coming back, more concerned about broad aggregates of the labor market and economy, not necessarily showing any immediate signs of concern. So that's where I'm coming to on that. Let me know if that is helpful. And then Rando asks, I notice every day, 8 a.m. Eastern, there tends to be a lot of movement. Why is that? I think that has to do with a lot of the funds kind of getting more active around 8 a.m. You see momentum managers start to, do some of their positioning ahead of the day, ahead of the week. You see some of the algos start to fire up more. You see some of the earnings events start to be gauged a little bit more, particularly this time of year around earnings season, where there are really a lot of earnings happening at the same time. You've got desks parsing that info, trading off that info. You've got more news and economic events happening. So I would imagine it's a lot of that, but there's probably some more specific reasons to, why trading desks are firing up at that specific time. What I know from talking to folks that are on the corporate side and the commercial side is a lot of folks are really just getting into work and starting their trading day around that time in the US for those East Coast offices. So let me know if that helps. And good morning, Loki. And markets are open here, 9:32 a.m. Got a bit of a pop coming off of that pop here. And remember, we're watching that 60.59 level as our key pivot here. We're also watching the 20-minute opening range. And from there, some of the options levels that start to emerge from flows. Seeing a nice little bounce off the point of control. And we still see that large offer overhead, that interest overhead that is overall constructive. I think this market wants to reach up there and fill that offer. And we do see offers building overhead to post open. So that is constructive. That's really what you want to see in a sense. If you're looking at the market from the perspective of it being a continuous auction, you're seeing that idea that we've got more interest in higher prices. So now the burden of proof is on buyers to show they have demand to push through those offer zones. But so far, I'm inclined to think that they're in a pretty good place to start doing that. Let's take a look at some of the heavy weighted stocks in the S&P and NASDAQ here, starting with Apple off the open. Apple slipping a bit here, seeing a bit of pressure off the open. And we're just going to get some live quotes for some of these. Apple down about 3.24% off the open from what I'm seeing here. Yeah. Yeah, a bit of pressure on AAPL. This one, this is a company where I think the big concern I have about them, other than the technicals and the trend break that seems to be starting on this, and we can just kind of quickly look at that, but you can see the technicals on Apple look pretty bad, rejecting at the 50-day, breaking that trend line. So seeing some continuation lower today is not terribly surprising on AAPL. But the other concern I think that folks have is, where is the innovation engine at Apple? What's become of it? And it really has not been able to excel in some of these key tech themes, whether it's AI or the cloud or their services business, which has helped to make up for some of the lackluster growth in their hardware products, is certainly not giving us the kind of growth we need to offset concerns about a broader slowdown at the company. So Apple continuing to sell down now, down 3.5%. Then we have Amazon. Amazon showing us a different picture than Apple altogether. Amazon actually making a push higher off the open, getting a little bit of a rejection at that offer at 231. There's 35,000 shares on offer up there. Amazon up 2% so far today. So totally opposite picture than what we're seeing from Apple. And Nancy Pelosi did buy Amazon and Alphabet calls while selling Apple and Nvidia shares. So we also have the quant of our century making her call here. As I'm saying this, Amazon rejecting from that 231 zone of offered liquidity. So we can consider that an area of resistance to watch today. Looking at Alphabet shares, a nice pop filling that 202 offer and then rejecting lower. So what that tells me is that there was enough demand to get up there, fill those 19,000 shares, but after that, buyers got pretty tired, and it's looking like we could get back down to this 199 level where there's a 39,000 bid just idle there. Meta shares also down just a bit off the open, not looking quite as volatile as some of its other constituents in the Mag 7. Meta up just about 0.6%, but closing in on session lows here. Microsoft consolidating, heading towards the lower end of its price range. It's up just about 0.1%. And heading right back down to the lower end of this range, we do see some demand at 428. I imagine that's going to be an important level for the stock here. See if buyers are able to stage a defense. And NVIDIA also popping and dropping lower, making new lows on the session here. NVIDIA shares up still about 0.4%. And then finally Tesla. Tesla actually getting chewed up a little bit here after the open. Shares falling 2.75% on Tesla. Let's shift back over to the NASDAQ and see what's going on in the tech-heavy index. And NASDAQ having a pretty nasty red candle there on some of that weakness we're seeing in the techs. We're just going to zoom in a little bit. And continuing to push to new lows on the NASDAQ. Let's check the S&P 500 futures. Kind of a similar look here. So checking in on cash indices here after the open. NASDAQ up now just 0.1%, reversing that earlier pre-market rally where it was up close to 0.8% when I checked earlier. S&P holding a bit more firm, still up about 0.4%. Russell 2000 up 0.75%. The Dow 30 Boomer Index up 0.5%. S&P crossing below my pivot of 60.59 to the downside, seeing some passive sellers layering in those selling orders, adding just a bit of a pressure to the tape here. Let's check on Bitcoin here. Bitcoin also slipping from its earlier highs. Remember, it was trading above 105,000. Now it's trading 103,000 and change, giving a sense that risk appetites are diminishing across several different metrics. Let's take a look at rates, and we also see some slipping lower in 10-year note futures, implying rates are moving higher off of their lows now. 10-year note yields 4.574%, now down only about 3.5 bips. Dollar also climbing a bit off of its recent lows, but euro is still overall up on the day. So still looking pretty constructive for the dollar down day idea. But the stock market not particularly happy so far with the techs performing as they are. Apple back now making new lows on the session with a very large demand zone forming below us. We've got 221 with 231,000 shares on bid and 220 with 166,000 shares on bid for AAPL. And I've been asked, can we look at Tesla? Absolutely. We can sure look at Tesla here. Tesla continuing to drop. The stock is now down 3.5% and making new session lows just about 3 minutes ago here on TSLA. 410 being a pretty important level for this stock based on that demand zone forming there. About 67,000 shares on bid. And then 400 below that, a similar demand zone. A lot of this has to do with the positioning in the options market and how market makers are hedging in near time in the shares. And we can see that 410 looks like they want to absorb that. Sellers getting a little bit more aggressive here. Low-key says, hey, Mayhem, I'm trying to learn more about the FX market, which is like USD JPY, your USD, pound sterling USD. Those are the ones. Those ones are more tricky to trade than equity futures. So I think the Forex market is pretty fun to trade, but I also think that it's keyed a lot off of policymaker chatter, central banks, country leadership, whether the executives or, the consensus of legislature or otherwise. And then to some degree, it's also based on rate differentials and flows of funds. So it's an interesting market. I feel like right now there are probably opportunities to go long GBP versus euro. I know that's a less popular pair trade for some of us folks out in the United States, but it feels like there's an opportunity there. It also feels like the yen, which has had just a really brutal time and then had this counter trend pop, and maybe time to start looking to fade the yen once again. I don't think the Bank of Japan is going to hike quite as much as people think. So those would be my two currency trade ideas going into Q1. We can see on Tesla, they looks like some of that order was absorbed here around 410. We can see that in the session volume profile, about 54,251 sell side delta. Let's take a look at some of the other popular stocks here. Nvidia slipping a bit and then popping back up, so making new lows at 9:40 a.m. and now bouncing off those lows and trying to retest that point of control from below. Microsoft just hugging the lows that it's been. It's not as dramatic per se as some of the other Mag 7, but Microsoft down about 0.6%. Looking like it's threatening a new low here. I'd watch 425 pretty closely. That is the largest level of bid liquidity, really anywhere near price. And obviously, we have a very large level of offered liquidity up here at 435. Meta coming off its lows, bouncing up to the point of control, testing 618 essentially, just around the level it opened at. So really trying to stage a recovery, up now about 0.6%. And you can see there's some pretty large levels of offered liquidity on Meta, but there's also more bid shares than offered shares. So there is still some more interest in lower price on this one. Alphabet, also like Microsoft, hugging those lows that it made earlier. Not a particularly dramatic trade today. Alphabet still up 1.31%, really retracing some of that initial move higher that we saw. And then coming in, making some new lows and holding above 198. We're going to be watching 198 and 196 here. 198 because it's right around that session low, and 196 because that's really a larger level of bid shares, around 16,598. And with Amazon stair-stepping lower. So it started off quite strong off the gate. Amazon was bid up like 3%. Now Amazon's given back some of those gains, bid up now 1.31% as it makes new session lows. And coming back to Apple, Apple sort of stair-stepping lower. This is a microstructure downtrend. You see an Apple now down 3.75% on AAPL. So checking back in on the S&P. S&P now moving back higher, pushing above that 60.59 pivot, the point of control, and retaking the vol trigger, seeing some passive order flow coming into S&P futures, helping to support it as well with this 178 contract iceberg being executed. And we're starting to see some of the options flow coming in, and it is favoring calls versus puts on the S&P. So far, that flow looks constructive here. We're also just about to round out that 20-minute opening range, which is giving us about a 15 handle range. It's around the averages that we tend to see. Let's check in on the NASDAQ as well. NASDAQ also looking like it wants to try to put in that low and reverse higher here. So we're starting to see some more constructive price action after that initial draw. Been asked for thoughts on Alibaba. So I think it's interesting for Baba. What I'd want to see, just as like a really quick and dirty chart analysis, is a sustained push above the 50-day. Today you can see it tested it and rejected. So I'm not super happy about that, but that can happen. You can have a couple tests, rejects, you're kind of like knocking on that door. What I want to see is a decisive push above that 50 and hold above on a closing basis. That would have me thinking that we could actually start to see a more determined push. The other thing that I want to see on Alibaba is the same thing that I'd want to see on silver. I'd really want to see Chinese stimulus manifest in a more tangible way to stimulate the domestic economy. I think if the Chinese government moved in larger force with a more broad effort to stimulate domestic consumption, where it's been very weak, that would put a big floor under Chinese stocks, give them room to move higher, and also give room for a lot of key commodities and industrial metals in particular, like silver and copper, to move higher as well. And just some consolidation really here over the last several minutes. What I'd really want to see to get more confident of continued upside is the flows in calls continuing to dominate the tape. Right now they are, which is constructive. I'd like to see a push above this opening range and absorbing this liquidity overhead and building some acceptance here. And I think we'd be able to see a sustained push up from there, likely into some of these next levels of offered liquidity, which we can see are continuing to build. So we have 6090, 6100. Then we have a key level of gross gamma positioning on the options chain, which I believe is going to be around. Let me just actually look at the chart here. Give me a sec on ES. See some selling pressure coming in here too. That's what that noise is telling us. Some aggression, a little bit of seller exhaustion here. Yeah, that's going to be just around 60.50 SPX. So the biggest thing that we're going to want to watch for is really the way that we break out from the range and how options flow takes place. We can see now flow has shifted the other way. So as we've been looking at this and watching this bump to the top of the range, we're starting to actually push to new lows, and we're seeing now put flows in excess of that of call flows. So 4K on the hot put and warm put versus 3K on the hot call and warm call. That prompts the midpoint coming on screen, showing us the middle ground between these flows because they're relatively in balance as well. Neither side has a decisive advantage here. Now, in situations like that, it implies a choppier trading environment unless and until one side is really showing more dominance of the tape. I like to see the top two flows for calls, for example, in 40% or greater volume than the top two flows for puts. Today, we're not quite seeing that. It's much more imbalanced. Now the hot call and the hot put, similar 4K volume on each contract. So for now, I'm more inclined to think that we chop unless these flows start to take shape in a different way. We'd want to see one side of the tape dominating those flows by, the top two added together, 40% excess, the top two of the other side. So let's say, for example, the top two calls in excess of the top two puts. And guess what? With that latest update, and this is really changing fast here, the top two puts are now in 100% excess of the top two calls. So 8K on the hot put, 8K on the warm put, 4K and 4K on the hot and warm call. So that is giving us a sense that there's some early hedging flows taking place. There is interest in lower price here. So if we're able to break below the bottom of this range and build some acceptance, that does suggest we could have a downwardly trending day. We also see some interest in that 59.50 level, about 656 contracts on bid. So low key in terms of Forex trading, I'm looking at it more of like a swing trade. I don't tend to day trade Forex pairs too much unless I have some high confidence setup. I find that my probabilistic outcomes improve over longer time frames for Forex. So, long GBP EUR would be like a swing trade that I would probably have on for, a couple months. And then fading the yen, I mean, I've been in and out of that trade for years, and I'm thinking we're starting to get to a point where it makes more sense to fade it on a swing basis. But in terms of when to trade on an intraday basis, I would shy away from directly trading economic events simply because we don't know how either party may be hedged into those events. So we don't know, if there's a large trading desk that's already hedged for the worst case scenario in an event. It comes in bad, but it's not as bad as we think. And then they take those hedges off and it has the opposite effect of what we think. The pair should be down, but it's up because there was hedging ahead of that event. So I don't tend to trade the events too aggressively because they tend to be pockets of illiquidity and larger moves to either side, kind of shaking out both sides of the trade that have too much leverage on. I tend to trade the momentum. I tend to trade the things that I see that give me a sense that there's some room for continuation. So yen versus the dollar has just been a very long-term downtrend. So that would be where I'd be capitalizing on that. The other way that I look at it is I try to get a little cute with the macro analysis and look for differentials that don't necessarily add up. So with the Eurozone versus the pound, the Central Bank of England has been showing some pretty strong resilience versus the rest of the banks that have been cutting rates. I think that versus the Eurozone's fiscal priority, essentially, that they're not going to have a choice but to cut to relieve some of the debt burden of their governments, makes it more attractive to want to long the pound sterling versus the euro over the next several weeks to months. So that's kind of how I look at those two. And I think we've been in a bull market for quite some time in terms of the equity market. I don't think any of that ever changed. I don't think we were in a bear market anytime recently. I just think that we're in a more turbulent environment, and the risks, because liquidity is diminishing, are starting to rise. And folks, that's going to do it for this episode of Back to the Futures. If you want to learn more about Bookmap, visit traderaid.com/bookmap. You can get up to 40% off. I do these streams every Tuesday at 9 a.m. Eastern. You can also get 20% off of TraderAid. Visit traderaid.com, learn more about what we do, and use the coupon code Mayhem20 at checkout. You can also get a 5-day free trial on our monthly plan. And if you're interested in learning more about this SPX options visualizer I have on screen, we just produced a video. You can learn more about it at traderaid.com/SPX. I want to thank the Bookmap team for having me back weekly. It's always fun. And stay tuned. This live stream will continue on Twitter or X, whatever we call it now, and on YouTube. So I'll catch you all soon for my Bookmap stream next week, Tuesday at 9 a.m. Eastern. And stay tuned on my YouTube channel and on Twitter, as this live stream will be going throughout the day and into Netflix earnings.